The world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Putting together this episode has been really interesting, embarrassing, hilarious. Wow. The world, firstly, has moved so fast since episode 1 when we were, just post-Brexit. We were in the midst of the Pokemon Go craze. We were first kind of thinking about what mixed reality experiences could potentially look like. Blockchain was still more or less akin to voodoo. Certainly some of the real tangible proofs of concept and implementations hadn't been seen yet. And Trump was a punchline, not a president. I suppose it speaks to the novelty of the medium, podcasting and general kind of audio content generation. But going back through the first few episodes must be what, PhD students experience going back to read papers from middle school. It's been, oh my God, you cringe when you hear the sound of your voice. Forget about the audio quality. In fact, I should apologize in advance because some of the stuff from those early episodes was rough. I'm glad we've progressed a bit from there. In this episode, this holiday special, if we can call it that, and this will be part 1. We'll do another part at some other point over the holidays before we get back to the normal rhythm and structure in early January. But I thought this would be a great opportunity to, rather than put together a new episode, really dig back through the interviews we've done so far and try to pick out the most relevant concepts that have come up, follow some of the threads that have shown up in multiple episodes, and think about what the experience and the expectations of some of the most knowledgeable, the most experienced people in digital banking, fintech today are seeing and where they expect things to go. You read a lot of lists and articles this time of year about what 2017 is going to look like. I feel no need to frame it that way per se, but I do think that what the incredible guests we've had on over the course of 2016 have been seeing, have been thinking about, have been doing, are more and more going to be what the broader market starts to look like in 2017 and thereafter. So enjoy today's show. As always, get in touch at Rebank Podcast on Twitter, or connect with me, your host, directly at Will_Beeson. If you enjoy the show, subscribe on iTunes, Stitcher, SoundCloud, or check us out via our website at www.bankingthefuture.com. You're one of the greatest audiences a podcast could ever hope for, and we're hugely appreciative of your support. Enjoy today's episode, 2016 Year in Review, Part 1. To kick us off, here's Jeff Tijssen from Capco on what incumbent banks are doing to stay abreast of developments in technology and fintech.
A lot of banks have either set up their own accelerator program, they're partnering with an accelerator program, whether it's a Techstars or Startup Bootcamp or some other organizations, or they've set up an investment fund to work with and invest in different startups, whether that's a Santander or an HSBC or Barclays, other organizations who've done one or multiple of those things. I do think that the banking landscape is changing significantly. So I think you're seeing a fundamental change at the moment in the banking landscape.
Jeff closes out with the key comment that in his view, i.e. the view of someone plugged into both incumbents and challengers, fintech and traditional banking and financial services, the industry is fundamentally changing. Now, there's no doubt in my mind that that's true. It's nice to hear it confirmed by someone like Jeff. Jeff makes the good point that pretty much all incumbent institutions are pursuing a range of tactics to keep pace with changes in the industry. Is the right answer an in-house accelerator? Is it an innovation lab? Is it actively pursuing partnerships? It's probably all of these and none of these. It's probably as much about mindset at senior management. Fundamentally, it's a decision. Does a bank want to operate on the cutting edge? Does a bank want to anticipate, and deliver to changing customer expectations? Or does the bank fundamentally believe that a lot of the change we're seeing will be relatively short-lived, will happen more slowly than some believe, and then incumbents will have time to catch up? Personally, I think the answer falls somewhere in between. I think there's a lot of hype about the speed and disruptive nature of changing customer expectations, demand for new propositions, but fundamentally, we've been banking for decades, centuries, in ways not dissimilar to the way we bank today. I think that there are all sorts of currents reshaping customer expectations, and I think that'll continue. But I think it's flawed and short-sighted to think of customers as a single group. Different customers will want different things the same way they always have. And I think one of the greatest innovations in banking in recent years has actually been the influx of competition leading to increasing specialization throughout the industry. Moving away from this world in which enormous international monolithic banks offer all products to all customers and don't necessarily do it particularly well. In terms of economic stability, in terms of customer experience, and in terms of bank bottom line, the ability to specialize is where the future of banking lies. But yeah, sure, easy for me to say. Try asking an incumbent bank to give up millions of customers, to narrow its focus on a finite range of products, geographies, and clients. In the next segment, Skylar Lyon, senior data scientist at Accenture, walks us through what's next in data science and how the coming advances are likely to impact our experiences as consumers.
This idea of moving from batch processing to interactive processing, whereby, before those sort of recommendations and those inferences that I mentioned earlier were being computed, maybe at like a nightly kind of level in a batch process where all of sort of the day's signals have been rolled up into a database and compute engine, and then those sort of batch transformations and associations and analytics have been run on top. And where we've moved to is more of this interactive notion. We're seeing a lot more memory, basically this notion of interactive analytics, visualization, association through in-memory computing.
It's nice to know that banking isn't the only industry affected by batch processing issues. But while the move from batch to real-time is important, Skylar takes it one step further.
And now we're turning the database inside out, in fact, and saying, that it's that the whole database notion and convention is inherently flawed, and that what we're really looking at are streams of data. And a stream is really no different than a database. It just has, a longer history. And so as compute engines have moved toward this notion of directed acyclic graphs and following sort of a graph theory approach toward the operations and transformations on a data set to produce the output. That, along with these streaming technologies, have supported more real-time streaming analytics behavior. And so what that means and how it manifests itself is this notion of going beyond personalization to contextualization.
Not surprisingly, we'll see these points around contextualization and leveraging the inherent components in new devices come up time and again with other guests. I know the audio is horrible. This was episode 2. Hang in there if you can. I promise the audio quality gets better as we go.
The other piece I see is this notion of virtual environments and the blending of the physical and digital space. How what we've seen with Pokemon Go is obviously these augmented reality layers overlaid basically on the real environment in which you interact, and so suddenly, your physical space it becomes part of this digital world in which the gameplay operates in. And I think that we're going to see sort of both as AR, augmented reality, and VR, virtual reality, continue to develop. They're still very much in sort of their nascent stages, and many use cases are just starting to be fleshed out. But I think we'll start to be supported of this mixed reality sort of world where it's part virtual, it's part augmented, it's part physical, and it's part digital.
I won't even try to summarize what Skylar was talking about in detail. I'll leave that to the data scientists. But the points that stood out for me were around this transition from personalization to contextualization, and moving from recommendations, advice, being delivered based on who you are, to being delivered based on where you are, what you're doing, what time of day it is, what you've done recently, what speed you're moving at, crazy data points that weren't available in the past. And moving to a more real-time processing paradigm, as opposed to the traditional batch paradigm, really enables this. I think the other part, too, is kind of that power seen within the context of something like, as Skylar mentions, Pokemon Go, or this concept of a blended reality, effectively digital combined with physical. Now, whether that's through new interfaces like VR or AR, or whether that's simply something like Amazon Go, which we've seen come out recently, which is really pushing digital in the physical space beyond what we've seen before. I'd expect this to be an important trend in 2017. Next, let's hear from Jason Bates, co-founder of Monzo and 11FS, on what's hot in banking right now. Taking a step back and looking at banking more broadly, what are you most excited about in banking right now?
Wow. I think there's three themes that excite me. First is a move away from traditional commodity financial products that everyone recognizes. The very sort of traditional. You used to have your grandparents had a passbook, your parents got statements. You've probably been looking at the equivalent online on a web page and now on an app. But it's been a digitized process. We've taken something that's very traditional, whether that's a current account, a savings account, a credit card, a loan, and really just replicated it. So it's a little bit like the start of the internet, where newspapers would just essentially put a newspaper on screen and even have like a fake page turning mechanic. We're really in that sort of, we've just digitized it, but no one's seen what a digital bank looks like, or truly what digital services are like. So I think that's seeing the impact of what real-time, intelligent, connected, contextual services can deliver for retail financial services is amazing. So I see that enabling a whole new world of these intelligent financial services that actually fit much more closely with end customers' lives than they have previously. You log in online to to your current account, and it gives you a balance that's a few days out of date, and a statement of semi-cryptic transactions, with 18 characters of text to tell you what you were doing at some day. There's not even a time associated. And then so you get this sort of basic transactional and basic data. But people have to do a lot more in their lives to kind of run their path from paycheck to paycheck. That's a pretty complex journey, with all of the overlapping quarterly, annual, monthly payments, with trying to save for some things, with borrowing for others, with sending money across the globe or to friends after dinner, and people have to work that all out and do that all themselves, or they don't. They just kind of like put a thing, lick their thumb, put it in the air, and say, well, I'm having a pretty good month, so I think I can afford that. So I think digital provides the capabilities of delivering what traditionally would be the service that you'd get if you were super wealthy and you had a private banker really looking at and looking after your personal finances, and delivering that to a mass market. So I think that's the first thing. The second thing is the push towards PSD2 and APIs. That can't be understated as something that's really going to shake up the industry and indeed create a new industry around these intelligent financial services connecting together in order to deliver contextual services, wherever the customer needs. So, you can go, you will be able to go to some point of sale to buy a laptop online and be able to borrow the money, see if you can afford it, borrow the money for buying it, and potentially insure it at the same time. Now, the ability to pull all those things together to prove who you are and how much you're earning by allowing some third party to connect to your bank, and by connecting into to financial advice services that online in order to help you better manage your finances, is just going to open up a huge area. And then looking further down the line, I've got to say blockchain is really the sort of 5 to 10 year bet. Or it's not even a bet. There's an inevitability. Try and say that word. An inevitability about the changes that's going to bring to the underlying core fabric of financial services.
Jason's key point, I think, and one that came up a couple times during that episode was this point around digital versus digitized, i.e., the difference between simply moving manual, traditionally paper-based processes online versus actually designing experiences from a digital starting point. So with the perspective of the user's going to be using this on a digital device, the components, the features that we have at our disposal, geolocation, fingerprint, camera, accelerometer, Apple Pay, can really allow us to do a lot more than we've traditionally done with banking on a computer or on a phone. I think that point plays in nicely with what Skylar was discussing just before about the increasing push toward contextual delivery of experience and this increasing blend of physical and digital. The possibilities are phenomenal. Of course, it wouldn't have been 2016 without numerous references and conversations about blockchain. I think Jason summarizes it nicely in this next piece, comparing where we are with blockchain today to the internet in the early 90s. Surely he's not the first person to make that comparison, nor will he be the last, but I think he paints an extremely clear picture that not only grounds us in reality, but makes clear the opportunities going forward.
My mental model is that really we're talking about distributed databases with that are tamper-proof, that then you can layer on smart contracts that enable you to automatically run tamper-proof code on that tamper-proof database that's being shared amongst everyone. So when you look at sort of retail propositions or end customer propositions, we don't really talk about databases now and how they affect the experience, and I don't really think we're going to talk about sort of blockchain and how it affects the experience, but inevitably it will bring some capabilities along that then the next generation of services beyond the real-time, intelligent, contextual and all of that kind of stuff, then what are the additional things you can do that are absolutely amazing when you layer in the capabilities and the virtues of blockchain. And I think we're going to see that coming, but not for a few years. I think we're seeing that we've just discovered Ethernet or networking computers together. And where do you start with that? Well, kind of within your own building. You just start networking things and using those capabilities internally. And then when you get to a network of networks, that's when the internet happens, and all of a sudden you're doing amazing things. I think people are looking at blockchain now and seeing the internet, but actually there's a long way to go there.
Jason's vantage point is particularly unique, having co-founded 2 challenger banks in the UK, but currently being involved in consulting to some of the larger incumbents worldwide. I was interested to get Jason's view on the biggest challenges faced by incumbents. Based on your experience, on your team's experience, what are the biggest challenges currently facing incumbent banks?
Wow. There's 3 that I point to. So the first has to be business model. Clayton Christensen points to disruption being defined by disrupting a business model, and traditional sort of large incumbent banks have a real problem in a low interest rate environment, with caps on interchange, with the CMA looking to cap overdraft charges and the sort of fees that can be charged to end customers, with fintechs coming along looking to bite off those high margin activities like remittance. So on one hand, you've got that squeeze, that margin squeeze that doesn't look like it's going away. We might have low interest rates for a long time. And on the other hand, you've got large cost bases of thousands of staff, hundreds of branches, massive organisations that have evolved and grown through the decades, and a new competitors coming along in order to challenge that. So there's definitely this margin squeeze, this business model question as to how can that continue? How can that really survive? I think secondly is probably a cultural aspect. You've got again thousands of people and senior executives who have earned their way, rightfully so, within a particular way of working for again decades. And it's extremely difficult to put that knowledge, to put that worldview aside, and to start banking and retail sort of banking again, and insurance from scratch, from what are the customer needs, what capabilities do we have, and how can we deliver against those. So while at the same time understanding that Barclays has 24 million customers, so that you can't just innovate wildly. You've got a big old sort of customer set. And your national infrastructure, you're supremely important to the country. So there's a culture problem, and then I think thirdly is the legacy IT issue, which I've not met a senior banker who hasn't admitted that that's very much the case. There's rarely a business case for changing core architecture. You're always looking to add on new services, and the best way of doing that isn't to rip out what you've got, and to deliver something else, but actually just to add on to what you've got. So it's a little like buying a really old house and knowing that you've got to live in it, and then knowing that you want to upgrade and add rooms. You can't really knock it all down and start again every few years. You kind of have to build on extensions, build on an extra floor, and unfortunately that leads to somewhat of a monstrosity of a house with little rooms, long corridors, and crazy plumbing, and that's where we're at. So it really is a project and program by program. Large banks have added on one customer view, online banking, mobile banking, bringing customer data together, had to layer on systems, which brings us to this point where there really are thousands of systems and tens of thousands of interfaces connecting these, everything from state-of-the-art new systems back to mainframes at the core. And that slows you down, that makes it tough, and that means something that for a smaller bank might be a £10,000 or £50,000 project becomes something that's 200, 500, £1 million for a large bank. So that's a tough place to be in.
We sat down with Chris Skinner earlier this year, one of the preeminent thought leaders in digital banking and fintech, who raised a point that I'd made privately before about the relevance of banks in the institution of political and economic policy. Before anyone gets too excited about fintech eating the world, let's make sure we understand the embedded interests, even more, the relevance of banks and banking in upholding the political and economic stability we all expect in the developed world.
I've been around long enough to see lots of new technologies always saying it's going to destroy the banking system and someone's going to replace the banks, mainly because most of us don't like banks. Even people who work in banks don't like banks. And the reason is that banks control our wallets, and anybody who is stopping us buying and living and doing the things we want because our wallets controlled by them are not particularly appreciated, but that's what they're there for. They are government instruments of control, because economies thrive or wither based on the capability of their banking and financial system. So whenever anyone says, "Oh, Google, Apple, Facebook are all going to replace the banks," I just laugh because I've never seen it in the last 30, 40 years, and I don't think I'm going to see it in the next 30 or 40. In the last 10, 20 years, most of the big banks in most economies have got bigger and got more market share of the customers' retail wallets, and have easily bucked off the trends of the assailants. And so what we see happening with fintech right now is you see lots of new startups that initially were talking about disruption and destruction of the financial system. Most of them have either been acquired or merged into the financial system, where they're offering something that's a bank core product. So the Stripes of this world, the Squares of this world, they're not disrupting. They're just making it far easier to use the payment system. So they're supplementing the system. They're not replacing the system. And the only one that really, there's two that come out of the end of this that are doing things that are different, is the companies that are addressing new market opportunities with technology. And those are the companies like Sophie, Social Finance in the US, addressing student loans and support, student mortgages on the basis of Henry's high earners, not rich yet. If you're at Yale or Harvard, you're probably going to do pretty well. Companies like Lending Club teaming up with Alibaba and Ant Financial to do a line of credit for small businesses in the US to import from China, which is taking away the difficulties of dealing with borders and cross-border payments and loans. But they're addressing markets that are high risk, and higher risk than the banks traditionally could serve. Funding circles lending to small and medium enterprises, SMEs, which banks don't have the data, the credit history, the knowledge, or the confidence to deal with in the same way. And Funding Circle ends up actually being a government conduit of small business finance, which, or certainly in the UK, that's the way they've evolved. So you kind of have fintech groups that are addressing markets that were underserved or unserved. And then on top of that, you now have the cryptocurrency, digital currency structures coming into play that can serve markets that couldn't move money at all, like sub-Saharan Africa, combining mobiles with mobile wallets and some form of digital currency that's cheap and easy. And so there's new markets. And that's really where I see the fintech landscape now, that you've got the majority of fintechs either working with the banks to make banking easier, or supplementing the banking markets with new market services that were underserved, or new markets that were unserved.
As far as next steps are concerned, according to Chris, one of the biggest opportunities is around financial inclusion, a point that was reiterated a number of times in future episodes. So we've talked a little bit about what banking, financial services might look like 5, 10, 20 years from now. How quickly are we likely to see meaningful departures from the current banking paradigm? And are there any challenges to change at scale?
I mean, the area that's most exciting right now is where you see the 4.5 billion people who didn't have any financial service until now getting some financial service because they've got mobile financial inclusion. So sub-Saharan Africa, where 1 in 3 people with a mobile phone have a mobile wallet that's actively used, is showing us a new opportunity to reinvent financial structures. A great example is from the Bill and Melinda Gates Foundation, talking about micro insurances, a bit like the Grameen Bank micro lending structures. Micro insurance could never be offered before, because if you want an insurance policy, you've got to actually be talking of a decent amount of premium payments per annum, and people in sub-Saharan Africa are living on $1 or $2 a day, so they can't afford a heavy insurance premium. But what the Bill and Melinda Gates Foundation is saying is that if you could pay maybe 1 cent a day, just 1 cent a day, and that would give you the confidence to know that if there is a famine, a drought, you can still eat, would you pay it? And the answer is, for most people, yes, they will. But no one could offer a 1 cent a day insurance policy in the past, but using a mobile micro insurance app, you can. And bearing in mind that more people now have mobiles than toothbrushes or toilets, it's become the key thing as a status symbol for most people to have a mobile. The cheapest smartphone these days in India is about just over $30. And that's a status symbol to have a smartphone rather than just a dumb phone. But even with a dumb phone, you can have a microinsurance, you can have a text payment, you can do things we can never do before. So for me, that's the revolution that we're seeing, that we've got 7 billion people connected globally in real time through a technology network that can exchange value, and that value exchange doesn't need to be through a bank. And for 4.5 billion people, it won't be. It'll be through some form of mobile wallet service. And that, when that becomes to fruition, we'll need mobile identities to go with it. And if Sub-Saharan Africa, Philippines, Indonesia creates digital identities on mobile wallets, do you really think we won't be using them everywhere else? Because they're going to be cheap, they're going to be easy, they're going to be secure and trusted. So, give it 5, 10, 15 years, we're going to have a digital identity scheme globally that's standardized, and I own it. And that's something that I can then give permission for governments and companies to access. And that's going to be a far better world, because that means that I control my identity rather than someone externally controlling my identity. One of the key things that's come up recently is the United Nations working on a program to give every single person on the planet an identity scheme, a digital identity scheme. And the reason why they're doing it is that 1.5 billion people don't exist on this planet because they never had their birth recorded. So those 1.5 billion people can be trafficked as humans, they can be sold as sex slaves, they can be put into imprisonment. No one knows because they've never actually been identified as being in existence. That's a problem that the United Nations has set as a goal to solve by 2030. And they're working with shared databases, mobile wallets, and biometrics to make that a realizable dream. If that's the dream that they realize, we're all going to share that dream.
Picking up almost precisely where Chris left off, we connected with Faisal Khan, international payment specialist, in episode 5, who again emphasized the relevance of financial inclusion. More specifically, applications for financial technology in the developing world, specifically around identity management. Identity, too, was a subject that came up time and again, not surprisingly in the context of blockchain. The question in my mind remains, how do we get there? Is it private sector led? Is it public sector led? Do we end up with projects coming out of both spaces? Later, Alex Tapscott tells us that in his view, as far as blockchain is concerned, everything we're doing today is valuable research and development. Can't disagree with that, because it doesn't sound like we're much closer to realizing the earth-shattering potential of blockchain now than we were at the beginning of the year. Bringing it back to Faisal, things like blockchain, and more broadly, the removal of unnecessary intermediation and friction, enables things like micropayments, microinsurance, that can drive behaviors, opportunities, and inclusion that have never been possible. On the point of the KYC register, rather the ID register, because KYC is such kind of a boring bank term. In terms of a global ID register, where would you, based on your experience in different geographies, see something like that first emerging? Is it developed world and it's a private led initiative? Is it something that grows out of kind of supporting migrants across the Middle East and Europe at this point? Is it is it emerging markets where there isn't such a maybe a well structured internal kind of database system in terms of identity?
You'd be actually very wrong when you assume that. Let me give you an example of the country I am in. I'm in Pakistan. Many people don't know, every time a citizen of Pakistan turns 18 years or above, they're required to get what is called the National Identity Card. The National Identity Card biometrically verifies you. That means all your 10 fingerprints are in the database, your iris and your facial scans are in the database. We have biometrically verified everyone over the age of 18. How more complex can you get than that? That is not available in the US. It's not available anywhere else in the world. We were the first country in the world to do this thing. So developing countries inherently have a very, very good KYC system. The question is this system, first of all, you heard about it today. Question is, do the regulators know about it? Will they take it? Will they accept it? It's like the high school equivalent certificate. Will we accept your high school equivalent certificate in our country? So that is one. And the second thing is, to answer your original question as to who might be the initiator, I think we will probably start seeing it emerge from two ends, if you will. One would probably be the internet giants, Facebook or someone else. And, with this Facebook, they would probably have some mechanism or method where you can enhance your ID verification, just like Twitter, a verified check symbol and so forth, Twitter verified account or Facebook verified account. They ask for additional details. And part of those additional details is they reach out to your social signal network and see if this person is who he or she cites they are. I think we'll see the same thing from the internet giants. That's one. The second thing is we may start seeing it as a small initiative by some payment company. I don't know, could be in the emerging markets, could be in the developed markets, but we will probably start seeing it mushroom out and others start taking notice of it. If PayPal, for example, came up with this thing today, it may just raise an eyebrow at best. But eventually, when enough traction is raised and enough people from emerging markets and the developed markets start using that system, it may just be spun off altogether. So who knows?
I think this is actually kind of a nice transition into to the topic of remittances, where you obviously have huge expertise and experience. So based on your work in remittances and kind of I guess a lot of the research and analysis that I know you do on the ground in developed and developing countries, what are the kind of the biggest opportunities you see for new companies, for startups in the remittance space?
So I think the most important aspect to understand about remittances is that they are the lowest hanging fruit. They are highly competitive. People jumping in, I mean, prior to 5 years ago, it was almost impossible to send $100 across. Anything less than $100 across. It would have cost you a significant amount of your transaction. Today, it is possible. So it's like going into an economy and saying, like going into UK and saying, we will not do any transaction less than £100. You can imagine the effect that would have on the whole economy. You can't buy gum, you can't buy a liter of petrol, and so forth, what have you. Can't buy a sandwich because everything is less than £100. But if you open the floodgates of transactions below 100 being able to be that one can do very easily, you can imagine the impact it will have on the global economy and on the local economy itself. I think the remittances are experiencing the same thing, where a person in Chicago and is working in Chicago, their wife is in Manila, she's standing at a grocery store, she is $4.80 short. She can message to her husband, send me $4.80, and he does so, and she gets it immediately. That kind of a transactionary framework doesn't exist yet. It is coming very slowly, but I feel that's the biggest area.
We connected with Alex Tapscott in the midst of a whirlwind book tour this fall, one that I'm not sure has actually ended. He and his father, Don Tapscott, published Blockchain Revolution earlier this year, a book that, surprisingly, given its financial technology-related subject matter, soared up bestseller charts. I asked Alex why he thought the book was so successful.
But I also think that we're really sort of capturing the moment, hitting the zeitgeist, as you will. There are more and more people outside of the world of the technology industry and the financial services industry who are trying to understand this technology. And, in the book, we make it quite clear that this technology will transform the world of banking and financial services in profound ways. But it's actually only one of 7 different transformations that we studied. We believe that blockchain technology actually represents nothing short of the second generation of the internet. For 40 years, we've had an internet of information, which has been a great tool for how we communicate and how we collaborate online, how we share information. But it hasn't had as great an impact on the underlying mechanics of commerce as most people would have thought. And it basically goes down to this one problem, which is that when you send information online, you're not sending an original, you're sending a copy. And that's good for information. This means I can send an email to 1 million people, or I can host a website that anyone can access. But if we're talking about money or stocks or bonds or titles or deeds or any kind of asset that has value and requires scarcity, then sending copies is a really bad idea. If I send you $20 in payment for something, it's really important that you've got that $20 and I don't. Because if I can send the same $20 to another person, or 1,000 other people for that matter, the money becomes worthless. And the same applies for, say, shares. If I can sell the same share of Apple over and over again, then the share is worthless, and I'm also breaking the law. Or votes in an election. If I can vote over and over and over again online, then it defeats the purpose of the process and undermines democracy. So it's great to have a printing press for information, but it's not great to have a printing press for value. And as a result, we still have to rely on intermediaries that sit in the middle of transactions and perform a whole bunch of important roles. So, intermediaries like banks, for sure, brokerages, obviously, but also governments, big technology firms, sit in the middle of transactions and do a bunch of important stuff. They verify the identity of parties. They establish trust. They perform all the business logic, like the clearing and settling of transactions, the moving of data. And they store that data in records that can be validated after the fact. So there are issues with intermediaries, won't get into in great detail. But what we have with blockchain is a transition now from an internet of information to an internet of value, where anyone, anywhere can transact and do business, move, store, and manage anything of value without necessarily knowing or trusting each other in the way they had to in the pre-blockchain era. And that is going to radically reduce friction in the system. It's going to enable greater inclusion. It will create a more fair economy, likely, and it will also spell trouble for certain intermediaries. Not all, but certain intermediaries. And as a result, that's going to impact all sorts of different industries. It's going to impact banking, but it's also going to impact technology, media, manufacturing, and every other major industry, we think.
Mm-hmm. I'm totally with you on the long-term implications, the long-term vision. I think what could be interesting to the audience could be thinking a bit about how we get from here to there, because there are a couple. If you think back to kind of the I guess the early days of blockchain, before that term was even widely used, people were excited about cryptocurrencies and Bitcoin, kind of this peer-to-peer, anti-establishment, anti-government, anti-incumbent monetary system use case. Now we've kind of gotten to a point where, 40 plus banks have joined the consortium like R3. You've got the largest banks, insurance companies, clearinghouses, stock exchanges in the world looking at ways to develop systems around this technology. Are we going to get to the 20, 30, 40 years in the future view of the power of blockchain via a retail-focused, consumer-focused, peer-to-peer development, or is this going to be led by industry? And if it is led by industry, what are the risks of real change being seen?
Well, I think it's going to be both. And I think that's a good thing. You mentioned at the beginning the philosophy of cryptocurrencies, or the ideology of cryptocurrencies, and their proponents in the early days was one very much of anti-establishment. This idea that you can transact and do business online without having to use these traditional third parties like banks or governments, for that matter. And that's an interesting ethos, and it's one that's not necessarily bad, but it's not one that will enable this technology to reach the mainstream. And you pointed out that blockchain technology started out with Bitcoin, and I think it's worth maybe demystifying Bitcoin for a second. So I think when people think about Bitcoin, they think of it as a speculative asset that goes up, it goes down, and you can buy it, you can sell it, you can make money on it. That's certainly true. And that's of interest if you're a speculator or an investor. What's more interesting, though, is that it's a cryptocurrency, which is to say a currency that is secured cryptographically, but also not issued or controlled or managed by a government or a supranational government organization like the European Central Bank or European Union. And that's really interesting. If you're, say, part of the diaspora that lives from your ancestral land and sends money home every single week or month, now you can do it using cryptocurrencies at a fraction of the cost. Or if you're someone living in Venezuela right now, where the country's going through, a slow motion collapse and the currency's being debased, it would be really helpful to have a store of value and a way to make payments that was not tethered to a collapsing government. But what's most interesting about Bitcoin is that it's based on this revolutionary technology called blockchain. And Bitcoin it's the first in use case, the first killer app, I think, for blockchain technology, but it's far from the last. And what's happened recently is that you've seen big enterprises and large incumbents, for that matter, looking at this technology as a way to not to democratize the world of financial services and bring about a better world, but to save a ton of money and maybe even make some money in the process. And, I think that runs against some of the early ethos of the industry. But I see it differently. I see it all as R&D into this technology. If the 40 of the largest banks in the world want to get together to explore ways to make the financial services industry more efficient, I'm all for it. When IBM and others helped the Linux Foundation launch the Hyperledger project, which counts 25 major firms, including a half a dozen big banks, as its members, I was delighted. Linux is an open source project that's helped to create the biggest operating system in the world. Maybe they could, apply those resources to helping to reinvent or help to bring about this new Internet of Value. There's lots of discussion now between private blockchains and public blockchains, private blockchains being the ones that are developed by consortia or by individual firms versus public blockchains like Bitcoin and Ethereum, which are open and decentralized and accessible to anyone. Again, it's so early stages that I treat it all as just exciting developments overall in the space.
Alex provided a bit of insight around how we get from this pre-blockchain world in which we currently live to a post-blockchain world. In his view, various projects start in various parts of the ecosystem: private sector, public sector, internal, shared, supranational, and slowly, over time, much like the internet, interoperability protocols are developed that allow connections and sharing of information from one closed network to another. There's certainly a precedent for this sort of development, and I don't see any immediate reasons why it shouldn't happen with blockchain too. It sounds like there are almost four kind of macro categories of blockchain use cases or users even at this point, and it's no doubt oversimplifying, but there's kind of the peer-to-peer kind of crowdsourced consumer use, likes of Bitcoin and Ethereum, at least in its early days. There are some corporate use cases which may piggyback off the likes of an easy-to-operate platform like Ethereum. There are large kind of cross-industry use cases, some of the KYC, AML type projects that are being undertaken by financial services companies, for instance, the insurance sector, settlement and clearing, supply chain, finance, that require coordination across large, often multinational institutions. And then there are the public sector use cases, the likes of some of which you mentioned before. To what extent is there likely to be kind of cross-fertilization, crossover between those areas, or do consortia specific to financial services build their own technology from scratch, implement their own use cases which operate inside their own industries, public sector build their own technology from scratch, and similarly the systems and the use cases are relatively self-contained, or how much of that flows over, using your internet analogy, into one system which touches all parts of the public and private business and consumer ecosystem.
I'm going to rephrase your taxonomy, just simplify it into two categories, basically. One is closed proprietary systems, and the other is open source systems, essentially. Because a lot of the systems that were developed to manage transaction data and trade flow for, say, the financial services industry were developed not in the internet era or the PC era. They were actually developed in the mainframe era. And so that was a time when everything that was built was basically proprietary and was vendor based. So you either built it yourself, or you were an IBM firm, or you were a whatever firm. These days, the most powerful computing tools in the world are actually open source, like the Linux operating system. So I think, like I said earlier, I think it's great that these big firms are working on these proprietary implementations. And I think that in some limited cases, they'll find lots of utility. But I think in general, open and distributed, and specifically open source, which means open to improvement and experimentation and development, it's likely to be the path that becomes the most successful. So right now, the blockchain world is fragmented. You've got Bitcoin, Ethereum, and these private blockchains. Whereas when you think about the internet, we have one internet. Well, the internet is actually a network of networks. So with blockchain, I think you'll see a similar not consolidation, but connectivity, where all of these different systems have to talk to each other as part of a broader internet of value, where you might use the Bitcoin blockchain to settle a transaction in a financial asset, but where the contracting language might be built on Ethereum, and where the data about that transaction may be stored in some proprietary ledger that's shared by a consortium of banks. But that's all conjecture. I mean, it is very early to say how this is all going to interact. I was at a conference at a big technology firm where the head of blockchain was asked this question. And he said, it's a great, intellectual experiment, but it's too early really to talk about interoperability because everything is still developing in its own silo, and it's very early stage. So for now, it's all happening in these different areas, but I think eventually you'll need some common standards, some common language, and some common technology to enable all these different systems to talk to each other.
Leaving blockchain behind for a few minutes, at least explicitly, Slava Solodkiy, general partner at Life Strata, a Singapore-based fintech VC firm, broke down the opportunities in fintech in Asia in a way that I think mirrors a lot of the developments, the opportunities that we're seeing globally, but with a handful of unique characteristics specific to Asia. What most interests you right now? What are some of the most powerful trends in fintech in Asia?
Regarding Asia, as I mentioned before, this region is very interesting because of size of unbanked customers, so also part of economy which belongs to small and medium businesses also very high, and you can involve these customers also into fintech area, not only retail customers. Regarding verticals in fintech which are growing here faster than others, we can talk about remittances, we can talk about infrastructure players which provide opportunity to accept cards, e-wallets, etc., like MPOS acquiring, online acquiring, because e-commerce startups here growing very fast. Also, loans, online lending, for sure is very very fast growing area, especially on, as I mentioned, on unbanked markets. For example, in Philippines, penetration of banking services is about 16 or 18%. It means that loan area belongs not to banks, belongs to pawn shops or microfinancial institutions. And finally, this kind of fintech startups will provide opportunity to use capital to grow for your business or for your personal reasons for extremely unbanked part of population. Also, we can talk about mobile banks or neobanks or challenger banks regarding overbanked markets like Singapore, Hong Kong, Seoul, or Tokyo. As you know, as everybody know right now, e-wallets, especially from China and India, growing very well. Alipay, like Paytm. Also, here Asian-based social messengers like Line, KakaoTalk, Telegram, they are much better or well known here than WhatsApp, and they provide opportunity for remittances or micro lending or micro insurance, or even for online trading or personal financial management startups to use their customer base of these messengers to reach potential customers and to expand via new products in their product line, and to increase their ARPU and profit per customer.
Most of the analysis and commentary around fintech is driven more by the tech than the fin, and even in the cases in which the financial angle leads, it's often, rightly I'm sure, born out of a perceived niche opportunity, arguably short-term. From an entrepreneur's perspective, who cares about the deeper trends that have created the opportunity? Though I do think a bit of foresight around what impact the interest rate environment has on the opportunities currently available in fintech, how much of the opportunity set is a function of regulation of incumbent banks, whether or not incumbent banks have reached an equilibrium post-2008 in terms of capital base versus balance sheet composition, and therefore whether some of the fintech opportunities that are being pursued at the moment are long-term structural opportunities or short-term tactical ones. Professional investor Michael O'Connor runs us through his thinking. So often in kind of mainstream media, you hear talk about fintech and what's going on in fintech and digital transformation and new customer engagement models in banking and financial services, which, while it's very much a real, tangible thing, is also arguably a symptom, a result of some very powerful trends that are affecting parts of the banking industry, the kind of the core of large developed economies in ways that don't necessarily make the headlines. And I think you have not only extensive experience in looking at those trends and investing off the back of them, but I think you're particularly good at communicating some complex themes.
I think technology has always been massively intertwined with finance, and if we look at sort of the major changes that have taken place, certainly in my lifetime, things like ATMs becoming prevalent, phone banking, and then later internet banking. If you look at the way the clearing cycle, the ability of people to move money in and out of their current accounts, the ability to disintermediate your own bank through online deposits, for example, much of this has happened in the established financial sector. I think what's really happened post-2008 and what's really created investment opportunities and what's really created focus on this is the fact that while prior to that, much of the financial innovation was happening inside the established players that were getting bigger and bigger, we started to see those big financial behemoths slowly get broken up. And as those tectonic plates have moved, that's created opportunities for smaller and more nimble players, and people have become increasingly focused on that. And it really is that ability to make very precise niche investments inside either finance or technology related to finance that people have got an opportunity to focus on.
So with your investor hat on, what most interests you about banking and financial services right now? What opportunities do you see?
I think that there are a myriad of opportunities. And I think it is that sort of disintermediation. It is the fact that you're seeing some of the larger, more established incumbent players, particularly in banking, retrace, and that's going to continue because the balance sheet pressures that's on those players is going to be maintained and is going to keep on going forward. People talk about legacy systems, but it's as much the legacy books that the banks have that creates the opportunity. This is what really constrains them from a capital space. If you've already basically invested all of the levered money that you can and you're having to reduce those assets because your regulation is saying that you need to hold more and more capital, your ability to generate new assets is very, very much constrained. And that's what really allows people with newer technologies that can outcompete, that can price differently, and that can assess risk more competently to move into that space.
Pre 2007, 2008, the model at incumbent institutions was very much originate assets, securitize, free up balance sheet, originate new assets, repeat. The securitization market fell off post 2008, but even 8 years on, it hasn't really come back. What's to prevent incumbents from reducing asset exposures via techniques like securitization in order to free up balance sheet space and start lending again?
I think in a large part it's regulation. And this takes sort of a myriad of different forms. The securitization market has recovered to a degree, and without any question, there are definitely securitizations that are going through, maybe not quite in the same scale and with the same breadth that they had previously. But I think that what has definitely changed is that the ability to move things off balance sheet at a ridiculously tight spread through securitizations is much, much lower. And in a low interest rate environment, that means that as a product place, they're much less efficient. So I think for me, by far the most significant thing when you look at the securitization market is where the senior tranches trade and where they're priced. And when you compare those to, say, equivalent deposit products, for the level of risk that's being taken, it's not necessarily. It looks like a wide spread, and what that's telling you is that the number of people who can buy those assets is limited. And I think a lot of this is due to the fundamental changes of the type of assets that banks themselves are allowed to hold. It's due to the increased regulation and the inability of, in particular, the investment banks to hold products that aren't for trading. That doesn't just impact the investment banks themselves. That creates a liquidity gap perceived by other longer-term investors, which reduces appetite there as well. And that's what's really constraining that marketplace.
Michael also offered words of caution related to the peer-to-peer lending industry. Time will tell whether these concerns are warranted, but Michael's certainly not the only one expressing these sentiments. So it sounds like you're referencing potentially some of the peer-to-peer lending platforms, which I suppose one of the concerns is the arguments is we can't necessarily rest assured that those models work or are in fact the panacea that some potentially view them as, simply because we haven't seen them, most of them at least, kind of operate through the credit cycle. Do you have concerns about the peer-to-peer lending industry?
I would have quite strong concerns about the peer-to-peer industry. I think it's conceptually a fantastic idea. I think it's very laudable in terms of what it's trying to achieve. But my concerns are based upon the fact that as it's become much bigger and much more institutionalized, the incentives for each of the different players are not necessarily aligned. So the peer-to-peer platforms themselves have generally been valued on revenue, not necessarily on asset quality, i.e. they don't have any skin in the game in terms of the loans that they're originating, which ironically is exactly the problem that people highlighted with CDOs, and it's why in that securitization market the originators were forced to retain a stake in the loans that they were originating, because if you have no incentive to screen the loans properly, then push comes to shove, there's a risk that you don't, which was exactly what happened with subprime mortgages, for example, in the States. So I think having bigger and bigger peer-to-peer operators that are valued purely on volume and not necessarily on asset quality is a concern. My other concern with that is that as those books are growing, any problems with the asset quality gets masked by the growth itself, because you don't have enough historic data on the loan book as it exists to ever really work out what your true loss ratios are. And I think when we see these things go through a full credit cycle, I just hope that that we don't actually see that the assets themselves are much lower quality than is being purported for the investors.
I'm almost shocked looking back that we went 9 episodes without going too deep on PSD2 and open banking. I think we touched on it a bit with Jason Bates and Chris Skinner, but Duena Blomstrom in episode 9 had particular views around the impending requirements coming out of PSD2 and the preparedness of national regulators to interpret and respond to some of the developments, some of the solutions that players will likely pursue in a post-PSD2 world.
I think what's interesting is how far ahead the PSD2 conversation is, and how behind the understanding of the authorities of the regulator of many countries is in terms of kind of what does identity really mean and how it connects to that, because they are different pieces to a degree. Whether or not you identify yourself with a set of documents and or checks is one topic. Whether or not you allow your data to be transferable between institutions is quite of another topic. And I think the blur between them is still very strong. I think there's a lot of space for different types of propositions to kind of grab the identity piece, whether we like it in the financial services or not. I mean, nobody says you can't identify yourself. You can identify yourself with PayPal and Google today. You're essentially using Authentics on the back end when you do that. Tomorrow you might be identifying yourself with Airbnb. Who becomes the standard as to what you want to use? I think it's very much a customer experience conversation and anybody's game.
Duena also weighed in with her expectations for where fintech goes from here.
Where you've seen a lot of innovation over the last few years has been on the front end, and whether we like it or not, there's only so many thousands of companies that are going to innovate the way you click to enter your mobile app. I mean, there's not a lot of pieces to the front end that still need rethinking any which way. We see a lot more innovation on the middle side, which is good. We need that bit of that translation between front end and back end, in particular now when it's not very clear who's going to become the de facto financial institution, and it's just a question of who grabs the experience and who's going to provide the pipe to it. So we need those middle layers, and we see some propositions coming up. I mean, you're going to look at what Solaris, you're going to look at the RC3, I think it's, what are they called, the new one, and there are a bunch of iPago and so on. They're not necessarily a banking platform. They are a set of APIs to help you connect to a banking platform. So I think that's exciting, the mobility that you get with that middle layer. The back end and this entire big conversation about AI and what essentially is a very disappointing use case for it, which is chatbot. I just find it so bizarre that we talk about AI, which is potentially, kind of the next being in our world, and instead of that, kind of what it means in financial services, can I check my balance on the go by asking my bank what is my balance, which by the way is a very silly application if you stop to think about it. But so AI is one topic. I don't think it's interesting in its manifestation today of kind of, again, chatbots, but what I think it's interesting in being able to kind of learn your behavior and modify it with really useful things. So in time, that's going to come. But to accomplish that, you have to have context and a container for that context. And it's not clear whether that's going to necessarily be, what type of smartphone, or is it going to be something you're going to wear or feel and so on. So I think we're a ways away from kind of bridging devices and what AI can do for us in terms of financial services and figuring those use cases properly. Blockchain, of course, which is the word of the year still, I don't know why, second year in a row, is exciting because it's the first time that we even talk about the back end. And I think 99% of people that are just wanting to learn about what it means have probably wasted a lot of time because it's nothing to do with them. But on the plus side, having enough mass of people looking at it means that you're going to be taking a much more serious look at maybe it's time to change spaghetti backends or build smartly from the beginning, or whatever it is that blockchain as a concept enables you to think of.
The topics covered in these first 9 episodes, I think, speak to the variety, the diversity of fintech, of banking innovation. If money in banking are at the core of so much of what we as human beings do, it's not surprising that it touches so many parts of our lives. It's interesting to see how many concepts came up time and again in different contexts. For instance, things like identity management in a blockchain context, in a financial inclusion context, in a front-end customer experience context. There's certainly a handful of components that underlie so much of our banking and finance and even consumption experiences. One of the things we'll definitely do in future episodes is expand the scope of the content to look at technologies that more tangentially relate to banking and FS and that are profoundly shaping our world. It'd be good, too, to explore some of the economic, political, and social implications of these changes. Things like AI have the potential to supplant huge numbers of existing jobs. I think we've seen time and again that those jobs eventually come back, but the period of transition can be rough. These concepts are worth exploring. Thanks very much for tuning in today. Keep an eye out for our Year in Review Part 2. And as always, reach out, get in touch. We love connecting with our community. Catch you soon for Part 2. Thanks for tuning in to Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.